So, hello. How many were here for the previous presentation that I made? Okay, almost everybody. Anybody here that's new that didn't see the 1 p.m. presentation? Well, welcome. So, in the 1 p.m. presentation, I covered the death of the global dollar standard. It may not necessarily mean the death of the dollar. I believe that we're going into a deflationary period first. When I wrote my book that was 2005 through the end of 2007, with some updates in March and April of 2008, and then it came out in August of 2008, I had predicted that there would be some sort of economic event, a crash or whatever, and the book came out just a month before all of that mortgage-backed security stuff started to unravel. And so the timing was excellent, and that's the reason the book sold so well. But in the book, I wrote that we were on a wild roller coaster of a ride, that we would go through we were expanding the currency supplies and on mild inflation, and there would be some economic event that would cause the threat of deflation. That was the crash of 2008. When I was writing the book, Alan Greenspan was the Fed chairman in the United States, and I said that Ben Bernanke would probably be our next Fed chairman. I had read many of his white papers and essays, and I had read when I was studying for my chapter on the Great Depression, I read his essays of the essays on the Great Depression, which is a book. It's his big thesis. It's the thing that made him famous. And I also read Milton Friedman's Monetary History of the United States and Murray Rothbard's America's Great Depression. So I got the viewpoint from a Keynesian, an Austrian, and a monetarist point of view before writing, so I could get a real balance in that portion of my book. But I said that he would do a big helicopter drop. I didn't call it quantitative easing. I called it a helicopter drop because they didn't have the name quantitative easing yet. And he fulfilled that. He did that. And I said that there would be a big inflation or reflation of the markets. And that happened. Oil had dropped back to $40 a barrel. It's now over 100. The stock market, the Dow was below 7,000 points, I believe, and now it's up at 16,000. And then I said that there would then be a real deflation, a contraction of the currency supply. Our currency supply relies on all of you to borrow more into existence constantly, and it has to be a greater quantity being borrowed into existence than we're extinguishing by paying off debt. When you pay your credit card bill or your home mortgage, the dollars that you pay those with vanish. The bank gets them, it cancels out a debt, but in canceling out the debt, those dollars are no longer on the books. The dollars that you may pay in base money, but when they credit your account, they're crediting digital credit dollars that they invented when you signed your mortgage application or whatever. And so I believe that we had the inflation followed by the threat of deflation, followed by a reflation, and now you are here. And there's going to be this big deflation, to which I said the central banks would probably overreact and print us either into a really big inflation or potentially a hyperinflation. That was my favored scenario, and the reason I think that deflation has to happen first is because looking throughout all of history, I can't find a single example where the masses, the population, gets rewarded for mass stupidity. It's usually the banks that end up winning, the big boys end up winning, and the average guy suffers at the expense of the banks. And if we went into with a societies all around the world being leveraged out, and our entire currency system on the planet being a credit system, not a money-based system, it's all based on credit. By the way, stop calling Canadian dollars or US dollars money. They are not money. Watch episode 1 of Hidden Secrets of Money. They're borrowed into existence. They are debt. Debt is not money. Debt does not retain its value. Thomas Jefferson once said that paper is poverty. It is the ghost of money and not money itself. And what we use today is fiat currency, national fiat currencies. They are the ghost of money and not money. This is the U.S. currency supply, and newsletter writers all over the world have said that we're going into hyperinflation or something like that. Well, with it expanding like this, I've been warning about this, but I haven't said that we were going into hyperinflation. All the world is trying to expand its currencies supplies right now, thinking that they can stave off deflation, and they can't. And I'll show you why. As they print currency, you can't get the public to take on more debt if they don't want it. As they print currency, velocity slows down. So this is velocity of money. It's how many times this base currency here, the purple line is base currency, it's the paper, US dollars, how many times they circulate in a year. What I find interesting, if you look at the expansion of the currency supply back here in the 80s and 90s and toward the 2000s, when you get it up here, it started to level off. But that was the same time the real estate bubble was happening, so velocity picked up to sort of counteract the leveling off, and we still had basically the same rates of inflation going on, or even extra inflation during this period when the currency supply was no longer inflating. Then everything crashes and we inflate the currency supply, but all of this is parked on banks' balance sheets. They want to make the banks not look bankrupt. And so when it comes to measuring this, it looks like it's parked on their balance sheets. It's on deposit at the Federal Reserve as reserves. And so measuring it, it looks like there's no velocity to that portion of the currency that they created. And because they're measuring velocity of the entire thing, and the portion they just created is parked, velocity suddenly drops to compensate. So velocity is falling off a cliff. So we don't have huge price inflation in the United States. And this is happening all over the world. They create currency, but velocity slows down. People don't use it as much to offset it. And Keynesians think that you can print your way out of deflation. And Japan is proving it. Year after year after year, for 30 years now, they've been trying, or 25 years, they've been trying to prove that you can print your way out of deflation, and they can't. They've been unsuccessful. So what are we doing? The rest of the world is trying. It's interesting. You remember the 70s was a bad period of time. There wasn't huge inflation going on here, but velocity was picking up. We had a lot of inflation back then. This is the total leverage in the world, in the monetary system. So you've got vault cash is the cash that banks have in the vaults should you want to go and take out some of your currency. And it's always a very, very minuscule portion of the currency supply. In the United States, I think they had $40 billion worth of vault cash when there was $850 billion in circulation back before the crisis of '08. And so basically this is how leveraged societies are. And this chart, I'm actually going through some of a presentation that's a little bit old. This chart is at least a year to 2 years old, and this has actually risen again. But what it shows is the higher this is, the more unstable the system potentially is. And so it shows that we're still in a danger zone globally as far as credit goes. So now we'll go into these cycles, and I'll show you the reason I think a big deflation is coming. This is the wealth distribution cycle, I call it. And we only have data on what I think is just one cycle of what repeats throughout history. But you go through periods of time where a lot of a nation's wealth is in the hands of a very few, and then there's a backlash from that, and you swing toward the opposite direction when they pass laws to try and steal from the rich and give to the poor and make everybody equal. And so here's the Great Depression, World War II, that's when I was born. And so from 1929, we were going down, and it bottomed in the 70s and then went back up. And that graph doesn't show all the offshore money that is being held. That's U.S. data there. This is, I'm going to talk about the baby boom demographic, so this sort of represents me. And I don't know if we've ever shown this graph in a video before, but I presented this information at a Doug Casey event called When Money Dies. And my presentation was called Money Never Dies, Currency Always Dies. Because only gold and silver are actually money. Currency has to be a medium of exchange, a unit of account. It's got to be portable, durable, divisible, something called fungible, where the units are interchangeable. If I borrow a $20 bill from you, I don't have to pay you back that exact same $20 bill. I can pay you back in loonies and toonies if I want, and you'll take them and the debt is settled. Money has to be all of those things plus a store of value. Currency does not store value, otherwise a single-family median price home would be the same price today as it was 100 years ago. If currency stored value, prices are stable. Currency does not store value. If we were using gold as money, you would see these short cycles of deflation followed by an inflation followed by an offsetting deflation as velocity goes up and down with the mood of the country. Are we all feeling good or are we all scared? That's what causes price inflation and price deflation in a stable money supply structure. So this is population demographic in 5-year increments, 0 to 5-year-olds, 5 to 10-year-olds, and so on. And this is 1940. And I'm going to go through the decades here. And what you want to watch here is children are the maximum consumers. They consume everything, produce nothing except reward for their parents. They get to see them grow and so on. They do incentivize their parents to work really hard, and their parents spend all of their currency instead of saving it. So this area right here that has children, they work very hard and all of their income gets spent into the economy. When somewhere between 16 and 24, 28, somebody either drops out of school and goes to work or graduates college eventually and goes to work. But on the average, when you start working, you're not making a ton of money, currency, and you might be sharing an apartment with 3 other people and working at some minimum wage job if you didn't go to college, or an entry-level job if you did. And so this area here in the darker green, these are still a net loss for society. They're consuming more of the economic energy in society than they produce and add to the society by buying things and paying taxes. As we get into the yellow here, now this is about the break-even point, and then here people are adding to society. And then here is the maximum spending demographic. So working age, maximum spending demographic. These people from 45 to 55 years old, these people, their kids are now going to college. They're buying all of them cars. They live in a 4-bedroom, 3-bathroom house. They're driving the biggest car, most expensive cars and the most cars of their lifetimes. They're paying for these college tuitions as their kids leave. And they're not saving anything because everything is getting spent putting their kids through college and stuff. Then they're empty nesters. The kids have gone to college and they go, holy moly, we didn't save anything for our own retirement and we want to retire in 5 years. So this actually does help drive the stock market and so on. They're investors, but they're going to sell their 4-bedroom home, move into a little 1 or 2-bedroom condo on the golf course somewhere and retire. And then here is the maximum social burden. I call it that because not only are the only sector that really booms that these people drive is the healthcare sector. And they are also liquidating stocks because now they're in retirement. So they're drawing out of the stock market, causing it to go down. So watch as we go through these years here and watch how these 2 columns grow and the little pauses in these 2 columns. Here come the baby boom generation born just after World War II. And these columns are starting to grow, and then there's a pause that'll happen here in the 70s. If you remember the 70s, the stagflation and everything, our economy is set up so that if our GDP doesn't grow at about 3% per year, it doesn't keep up with the required growth of the monetary system, this debt-based monetary system. If you don't borrow more currency into existence each year, the amount that you're paying off that is owed back starts a deflationary collapse. And so you need these sectors right here to grow at about 3% per year, or you get in some economic problems. So the baby boomers are coming in, now they're starting working age. Now 1970, watch this area, and this area here doesn't change all that much from 1970 to 1980. So this actually shrank a little bit right there. The 70s was a horrible economic time. This is US data. So in the United States, the 70s was not a very good time, and it's because this didn't grow to keep up. That's one of the major reasons. And then the baby boomers are coming in here now, and with the 80s and 90s, the stock market is starting to boom. This maximum savings demographic is going up and up and up. And then we hit 2000, and this is still going up, but here we are at 2010. So look at what is in this decade. Here we are in 2014, halfway through it. But this is going to shift over into here, and this is going to shrink. And so the decade that we're in right now, we're not done with it. But this is not keeping up with the required 3% increase in GDP every year. We don't have these people producing and paying taxes where there's 3% more of these people every year in that bracket. And then out to 2030, and the number of people retired for the number of people that are working is enormous, and it's a crushing weight coming up in the future. And this is not all doomsday. There's some hope at the end of the presentation. I'll play it in an automatic mode, and you can watch that wave go through there. And now sort of keep your eyes on these two columns. I'll do the same automatic mode, but watch them grow and pause and grow again and then shrink. And here we go. And demographics drives a huge portion of the economy, and there's no escaping it. There's nothing you can do except prepare for it. And the problem is the people that run the monetary systems of the planet have not prepared for it. They think that everything is the same as it was back in the 80s or 90s or 2000s, and it's not. It's dramatically different. If you could plot that maximum spending demographic over time with the energy that it adds to the economy on this axis, it would probably look something like this, and we have passed the peak. And we're sort of going in a downhill trend right now. That's actually a deflationary thing. One of the things that is going to cause probably the greatest stock market crash in history was passage of what's called the ERISA Act in the United States. Here you have the RSSP, is it? Your retirement account. What's it called? RSSP? Okay. Before these acts were passed, it was most big corporations had pension plans, and it was the corporation's job to sort of take care of their workers in retirement. And it was the contributions that were going into the pension plan were made by the company, and then professional managers that were not working with greed and fear in them. The amateur investor is controlled by greed and fear. The professionals look at the numbers, and greed and fear does not control their decisions. So they make good investors. The average person controlling their own individual retirement account is not a good investor usually. But before that, the ERISA Act in the United States and the RSSP here, you could invest in anything you want, and so could those pension fund managers. They could invest in gold or real estate. But then with the passage of the ERISA Act, and this happened in '74 in the United States, and it was roughly about the same time that pretty much every advanced country on the planet passed some sort of act freeing up corporations from having to provide for retirement and putting the burden on the individual. And it created a funnel to Wall Street and made it so that for decades you could only invest in stocks and bonds through your individual retirement account or your RSSP. It wasn't until the REITs came around that you could invest in real estate for retirement, and it wasn't until the exchange-traded funds like SLV and so on came around where you could invest in gold for your retirement. So this caused an enormous bubble, a boom to build up in these asset classes, and the result is we'll see a cycle here. Does everybody here know what a PE ratio is? Anybody not heard of a PE ratio? Okay, it's the price of a stock divided by the earnings that the company made in a year per share of stock. And fair value is between 10 and 15. Most people consider 12, 13, something like that, fair value. Undervalued is when you're not paying too high a multiple for the stock above what its earnings are. And then overvalued is about 14, 15 to 20. And bubble territory is anything over 20. And this is Professor Robert Shiller's data of PE ratios going back to 1880, I believe. And what you see is that there's a cycle, and whenever you hit overvaluation, there is always a march down to severe undervaluation. Here we have the roaring 20s and the stock market crash of 29, and then we've got a bubble here, again, undervaluation, 1966, and undervaluation in 1980. And then the greatest stock market bubble of all time, the NASDAQ bubble of 2000. And it crashed and it bounced down to fair value, it bounced back up into a bubble, and we're currently right at about 22, I believe, right now. But the thing is, you know, it has never visited bubble territory without revisiting undervaluation before a brand new bull market that's a healthy, real bull market starts again. Anytime you see this, it's a dead cat bounce. It's just one of the little jags that it makes on its way down to severe undervaluation. And so I believe that we are going to probably visit the most undervalued valuations in history when it comes to the general stock market. And it's simply the market rebalancing itself. We went further out of whack here than at any time in history. We've got to go further out of whack down to this side. And that population demographic that you saw is going to help all of this. As the peak of the maximum spending demographic moved into the maximum savings demographic over this past decade, the next decade they move into maximum social burden. And they retire and they start drawing down all of their accounts that are in the stock market. And so these are the world's stock markets, the S&P in the USA. We've got the English stock market, the German stock market. Singapore, you see before the year 2000, it would trade in different directions, but it became sort of synchronized with the rest of them in 2000. The Nikkei in Japan, the same thing happened. And then we have the emerging markets. This is Brazil, and it became synchronized in about 2004. Going the same direction. This is Russia. And the result is that today, virtually all the world's stock markets trade the same direction at the same time. And since I created this chart, this is probably 2 years old at this point. Since I created this, they're even more in sync than they used to be. So whatever happens with the US stock market is going to happen around the world. We're the ones with the problem with the population demographics. Australia and New Zealand don't have the same problem that we have. They have an up-and-coming younger generation, so their boom should go on another 10 or 20 years past ours, but it won't, because ours will drag the rest of the world down into this black hole. This is Nikolai Kondratiev. Has anybody here heard of the Kondratiev wave? Okay. It's a wave. He's a Russian economist that Lenin commissioned to prove that capitalism wouldn't work. And he went away and he did his studies on capitalism versus communism. And he came back a few years later, presented his findings that capitalism was the superior system and would work wonderfully well, but it will always suffer from these long wave boom-bust cycles. And for his efforts, he was rewarded with imprisonment in Siberia. So, the Kondratiev wave, and it has seasons of spring, summer, autumn, and winter. We are in a Kondratiev winter. This is a very different bull market than the bull market of the 70s. The bull market of the 70s was a Kondratiev summer. It was inflationary. Right now, the world's central banks, all of them, are trying their best to create positive inflation, and they can't. They keep on printing currency, but they can't get all prices to rise. It's only some prices that they're causing massive inflation in. The stock markets, for instance. And so the proof of this, I'm just going to use two of them, but if Ian Gordon he's the longwaveanalyst.com. He's got a lot more in-depth information on this, but I'm just going to use two pieces of proof here that there is a cycle that that goes along with this. That's interest rates. By the way, this is the Federal Reserve was established in this area, and so interest rates have had wilder swings than at any time in history since we've had central banking. Their mandate is to try and stabilize things, and what they've done is really upset everything. And here's prices, and you can see the correlation with these peaks, and then the Federal Reserve was established, and look at what happened with prices ever since the Federal Reserve was established. The East-West cycle, how many people have heard of this? Okay, very few. It's an obscure cycle. Maybe it's real, maybe it's not, but if you look back in history, there's a portion in time where the East, China, invented gunpowder and paper, and they were the first actually to use fiat currency. They lead the world in technology, and then they went and stagnated while the West had the Renaissance and came into this industrial era, and they were trying communism with Chairman Mao. Well, this cycle sloshes back and forth. It's a big cycle that peak to peak is about a 1,000-year period. So each half of the wave is about a 500-year period. But if you can't feel this happening today, you're not connected with the news or the rest of the world. China is coming up, and the West has sort of stagnated and is struggling to keep up with growth. And so maybe that cycle is real, maybe it's not. This is household debt as a percentage of disposable income. And I believe that this is all the data that there is. It goes back to 1946. But I believe that it's also a cycle. I think if you could this is the 100% line, so household debt being greater than disposable income. If you had data going back in history, I'd have a feeling that it goes right along with the Kondratiev wave, and it would look something like this. This peak may not be this high, but the roaring 20s would be somewhere in here, and then the Great Depression causes this big flushing out. Everybody that survived that was of working age and owned a house or a business or anything like that during the Great Depression, it scarred them for life. They were very, very frugal people. They got burned by debt. People lost the family farm, they lost their homes. And by the time all the liquidations were done, they were very afraid of debt. The Kondratiev wave is fascinating. I invite you to study it. Have I really got 35 minutes? How long, what time is it? 2:40. So I've got about 20 minutes. So I'll go into the Kondratiev wave just a little bit. The people that were of working age during the Great Depression, like I said, they got scarred. If they owed anything, the dollars to pay off whatever they owed became far more dear. Their income goes way down. The currency supply in the United States shrank by 30%. Incomes fell by 30%. Unemployment went above 25%. So a lot of people could not afford to pay their mortgage, or if they borrowed to buy something else. You know, with the inception of the Federal Reserve, it was the first time consumer credit was really available. Before that, it was all farmers that had to borrow from the banks cyclically with harvest and then the planting season. They would borrow to start the next year's crop. A lot of them lost everything, and they were very, very careful. So when the spring happened, it was a boom based on actual infrastructure. They built factories, and they did it with very little debt. We built roads and bridges, and we came out of the Great Depression very, very healthy and strong. But like my parents, when I was a kid going to school, there was an ashtray in a cupboard way up high where the kids couldn't reach it that their pocket change went into. And I'd get a silver quarter and a silver dime out of that thing to go to school with, or a nickel, I think. And the quarter bought this sectioned plate when I was a kid of a 3-course meal of like peas and mashed potatoes and a pork chop. Great food for 25 cents, and the nickel was for a carton of milk if you wanted one. And they were frugal, though. I don't know how many here, did your parents have a coffee can that they kept bacon grease in? They'd fry bacon, pour that grease in there, and then whenever they were cooking stuff, they didn't have $20 a gallon olive oil in the cupboard. They took a scoop of bacon grease and put it in that frying pan. And so we recycled everything, and so that was their mindset. And so they saved. As we came out of that winter and into spring, they saved a lot, and they had children, the baby boom generation. And at a certain point, they started to feel comfortable and safe, and they started spending some of that currency in the summer, and we had that raging inflation of the 70s. The currency came out of hiding, and velocity picked up. The currency that they were storing up during the 40s and the 50s, velocity was falling as the currency supply was increasing. Now in the 70s, currency supply is increasing and velocity is increasing at the same time, and we had that raging price inflation. Then the parents start dying off, and the kids inherit factories and real estate and so on. They go, oh great, now, and they've never experienced bad time. So now we can go out and borrow and have a good time. And so you go into an autumn, which is an inflationary period that's all driven by credit expansion. It's not real infrastructure and factories. The new companies that were created during this period of time were internet companies. They're phantoms that are online. They exist in the ether. They're nothing that you can see, feel, touch, and really borrow against. And ever since the year 2000, we've actually been in a Kondratiev winter, and the world's central banks have been fighting it. We are in a deflationary period. Right now, the European Central Bank is trying desperately to get positive inflation, and no matter what they do, they are unsuccessful at it. Japan has now been trying since 1990 to get positive inflation, and they've created trillions and trillions and trillions of yen, just expanding their currency supply immensely, and it doesn't do anything to prices. Velocity just keeps on slowing down. And so back to the world monetary systems. These things, every 30 to 40 years, the world has a new one. Like I said, this is a couple years old. It's now 43 years plus. I've been giving this presentation for quite a number of years, but it isn't online yet. But this also goes with the war cycle. You didn't see this at the presentation that I did at one, but there's a major war that goes along with each one of these shifts in world monetary system, and the emergency of the war contributes to the implosion of the previous monetary system and the adoption of the new one. And so we're in for something new. When you line all of these things up, the East-West cycle is very deflationary for the West and inflationary for the East. The maximum spending demographic, wealth distribution going from just a few people having most of the wealth in the country to the wealth being spread very equally back to a few people. Disposable income to debt ratio, the stock market cycle, the Kondratiev wave going into a Kondratiev winter, and a shift in monetary system. These things are all deflationary events, and the world's central banks are trying to stave them off with currency creation, and it isn't working, no matter what they do. So I really think what you're going to see sometime before the end of this decade is a huge deflationary crash, and then countries will print their way right into hyperinflation, because what will happen is they'll print and nothing will happen. And they'll print and nothing will happen. Because as they print, people are still scared and they'll save that currency and they won't spend it. And they keep on printing, and in my book I wrote that, you know, like the US government could do helicopter drops. They could refund all the tax that you've ever paid in your entire lifetime. Eventually there will come a time where people say, you know what, I've got enough saved up for retirement and I really deserve a new car, or I really deserve a new big screen TV. And when people start getting comfortable and that currency comes out into circulation and velocity picks up, you can have a hyperinflation without having to have the countries print their currencies into oblivion. And so how does this affect you, and what can you do about it? Well, the title of this presentation when I did the Doug Casey event was Money Never Dies, Currency Always Dies. And this detonation, this was a US presentation, has reached detonation. Kabam. So this is where the opportunity comes, I believe. I believe in a currency crisis, the people that are, there's going to be a wealth transfer. And for every 1,000 people that don't get prepared, the one person that does get prepared is going to reap rewards at a ratio of 1,000 to 1. There's going to be a wealth loss for the people that aren't prepared, and a wealth gain for the people that are prepared, and that it's just a transfer. There's going to be no currency necessarily changing hands, but what you're going to see is the value of currency plummet and the value of precious metals skyrocket. And that is a wealth transfer. And in the United States, there's nothing better that shows it than this graph. This is base money from 1918. The Federal Reserve doesn't supply data before that, all the way until 2 years ago. With QE3, this is up here now, and with the pullback in gold, this is down here. If you could take these lines back here, back to 1913, before the Federal Reserve, they converge. There was an equivalent amount of base money to gold at the Treasury. They expanded that, which was a lie, and then they had problems in the 30s, and there were bank runs. And they revalued gold in 1934 to 35 bucks an ounce, and the value of the gold at the Treasury once again equaled the value of all the paper currency, the base money in circulation. And then we go through World War II, this big expansion for World War II, and North Korea and Vietnam and Johnson's Great Society in the 60s and the 70s. And gold became free trading August 15th of 71. And the will of the public and the free market bid the value of the gold at the Treasury up until it once again equaled the value of all the currency in circulation. The opportunity is the spread between these two. This was the amount of opportunity. And so back in the year 2000, it was the greatest, it's as great an opportunity as existed here in 1970. But now with this pullback and the expansion of the currency supply that we've seen with QE3, we have the greatest opportunity in history laid at your feet right now. I believe that the stocks are a good thing, but I also believe that everybody should have some real physical gold and silver. I don't give advice, I never tell people what to do, but what I do is I buy gold and silver, physical. And so now, in a Kondratiev winter and in currency crisis, what happens is you wake up one day and the opportunity is gone. This is the Russian ruble from 1919 up until today, and there's these enormous revaluations. This is during the Russian Revolution, the revaluations of the currency. But look at the number of revaluations that they've had, and when you see the scale of these revaluations, it's just absolutely mind-boggling how much purchasing power the Russian government kept on stealing from their population. But what happens in a currency crisis, does anybody here, have they heard of long-term capital management? Okay, this was a hedge fund that blew up back in the late 90s, and it just about caused the entire world financial to melt down. We came within hours of everything freezing up and no credit cards working, not being able to get anything out of your bank account, everything being shut down. What happened was Alan Greenspan got a bunch of very smart people and the world's big banks all together to bail out this hedge fund, and everybody found out about it after the deal was put together. When Lehman Brothers melted down, did you find out about it before it happened, or did you find out about it after the Federal Reserve and the Secretary of the Treasury and everybody got together and came up with a solution, and it was already dissolved and other banks had Bear Stearns and Lehman Brothers? I mean, what happens is there's an emergency and a very few people keep it secret and they try and solve the problem, and then you wake up in the morning, problem solved. Well, what happens in a currency revaluation is there's an emergency going on behind the scenes, the public doesn't know about it, a few people get together in a room and they decide that the solution of the problem is to make gold, for instance, in this thing, the coming currency crisis. You might see gold go from where it is to, say, $8,000 an ounce, or $7,000, as Jim Rickards believes, or maybe $15,000 an ounce, like I think might happen. That's what it requires for that base money to cover the currency supply again, is about 15 grand an ounce or higher. And so the revaluations can be blindingly quick, and they can add up to some mind-boggling figures. This is the Russian revaluations. If you went back to Peter the Great, when he established the gold Russian ruble, and then the revaluations that happened during the Russian Revolution, 10,000 to 1, 100 to 1. In other words, your old currency is no longer useful. You have to bring it into the government and exchange 100 Canadian dollars or American dollars or whatever for one of the new currency that the government is coming out with. And then 50,000 to 1. That's 3 revaluations in this short period during the Russian Revolution. Then 10 to 1, then 10 to 1, and then 1,000 to 1. And when you add all of these together, 1922, 23, 24, 47, 61, and 1998, this went along with the long-term capital management problem. This happened 1 year after the long-term capital management problem, and long-term capital management contributed to the Russian default that caused this currency crisis, where the Russians, they ended up with 0.1% of their purchasing power after this currency conversion. 1,000, you bring in 1,000 of your current Russian rubles that you thought were worth something when you went to bed that night. You get up the next morning, you got to bring them into the bank, and you get to trade those 1,000 for one of the new ones. And what that adds up to is the Russian ruble was devalued 5 quadrillion times over that time frame. This is the amount of theft that governments can perpetrate on their populations. So the opportunity sometimes comes in a bull market that progresses and then peaks, and then you go into a bear market. That's in a Kondratiev summer. In a Kondratiev winter, many times it's a currency crisis that requires an overnight, lightning-fast revaluation, and the opportunity does not exist after that. I believe, though, that what will happen is you're going to see people, if gold did get revalued suddenly to $15,000 an ounce, the opportunity is gone there, but where is silver? So I think right after a revaluation, you would see people flooding into silver. This is the Dow-Gold ratio inverted. So it's upside down. This is the Dow Jones Industrial Average, or the US stock market basically, priced in gold instead of dollars. So each day, 3 minutes. Okay, I got to hurry up. I'm almost at the end anyway. So every day you take the points on the Dow, divide it by the price of gold, and you've got how many ounces of gold one share of the Dow would cost. And right now we're in this big pullback, and it's very similar to this pullback that we went through in the 70s, although not as big yet. It might get quite a bit deeper here. So it might sort of mirror that. But, and if it does, the revaluation will just be more intense, I believe. Fair value, I'm going to go back on this. Fair value is in this range of 3 to 5 here, where it spent a lot of time back in the late 1800s, early 1900s, throughout the 30s and 50s, it spent time in this range, and in the 80s. And then overvalued is this range of 2 to 3 ounces of gold. When it gets above 2, it's in bubble territory, gold compared to stocks. But we're coming off of the most out of whack in history. So if you draw some trend lines here, I really believe that the further down this goes, the more it's going to explode to the upside. And I think you're going to see a day where the price of gold is double whatever the points on the Dow are. And this is the gold-silver ratio. So I've inverted this also. So silver's value right now is 1/67th the value of gold. Historically, though, it was 1/12th, and then it was 1/15th when governments started manipulating it, the Bank of England and so on. But it's been out of whack for more than a century. Now, if we have this deflationary thing and you see gold pull back to 1,000 or even 900, I think that this could actually hit 100 again. So silver wouldn't keep up with gold, but I won't be buying gold. Right now I buy about 80% silver and take my currency, split it 80-20. I buy 80% silver, 20% gold. If it gets over 80, I'll be buying 100% silver, not gold, and it'll be going against all of the emotions. Your inclination is going to be to buy gold. I will be buying silver. I'll be going against the grain. And if it does go down to 100, I think the revaluation will be even higher. So it'll magnify your gains. If it went down to 100 and we went back to a valuation of 10, it means that you, by investing in silver, you got the gains of gold magnified by a factor of 10, so times 10. Right now, if we go to 10 to 1, that means it could be 6. And so here's the S&P from 1871 until today. The S&P only goes back to 1950. However, Robert Shiller just took the largest 500 companies in America. This is with dividend yields reinvested annually and then divided by gold. And if you take that and you invert it, you have the Dow gold ratio and then the gold Dow ratio. So instead of, go back again. So instead of the red line, instead of the Dow priced in gold, you have gold priced in shares of stock, the Dow or the S&P. And if you were to put $1 in here, this is my final frame, so I'll be out of here right away, and then shifted in 1929 from stocks to gold, and then from gold to stocks, and so on and so forth, your $1 invested there would be just under $11 million today. Now I know none of you were alive in 1871, but still, this is a way of developing generational wealth. It's very powerful, and it's powerful within your lifetime. Thank you very much. I'll see you next time.
This episode of Mike Maloney's Hidden Secrets of Money was brought to you by GoldSilver.com and the new Silver Pegasus Round. To learn how to protect your family and turn the coming economic storms into opportunity, visit GoldSilver.com.